In this video, we will explore the analysis of options from the perspectives of buyer and seller. We are going to look at how intrinsic value, time value, and different investment strategies help us understand the risks and rewards in the options market. To understand how an option is priced, we first need to look at the option premium. You can think of the option premium as being equals to the intrinsic value plus the time value. For deep in the money options, the intrinsic value is high, which means the total premium you pay is also a higher premium. However, for at the money or out of the money options, there is zero intrinsic value and the premium is only made up of time value, which makes these a cheaper premium. As a buyer, you will always pay more for an in the money option because it already has some real value built into it. Now, we should consider the uncertainty factor. At the money options carry the highest uncertainty compared to other types. The logic here is simple. Because the current price is so close to the strike price, even a small price move can completely change the status of an at the money option, tipping it to be either in the money or out of the money. This high uncertainty is driven by how much time is left until expiry and how volatile the underlying asset is, both of which are part of the time value. Let us set up a scenario to see how this works for a call option buyer who is bullish and expects the market to go up. Imagine the current index spot price is 17,562. We have four different strike prices to choose from: 17,300, 17,400, 17,500 and 17,600. You can see that as the strike price goes up, the premium goes down, moving from 327 for a deep in the money option to only 130 for an out of the money option. We can break these numbers down further to see what you are actually paying for. In case 1, for the 17,300 strike, the intrinsic value equals to the spot price of 17,562 minus the strike price of 17,300, which equals to 262. This means out of your 327 premium, 65 is time value and the rest is intrinsic value. In case 2, for the 17,600 strike, the intrinsic value is 0. So the entire premium of 130 is attributed to the risk associated with time. When we look at risk exposure, different strikes offer different balances. The 17,300 strike is considered high risk because it has a higher upfront cost with a max loss of 327 and a break-even point of 17,627. On the other hand, the 17,600 strike has a lower risk with a max loss of only 130, but its break-even point is much higher at 17,730. One important thing to remember is that if the index closes below 17,300 at expiry, all of these options will expire worthless. To see which option performed the best, we look at the return on investment if the index rises to 17,800 at maturity. While all options made a profit, the 17,500 strike gave the highest return with a 62% return on investment. The deep in the money strike at 17,300 gave a 53% return, while the out of the money strike at 17,600 gave a 54% return. This shows that choosing the right strike price is key to maximizing your percentage gains. Now, let us switch gears and look at call option trading from the seller's perspective. A seller usually has a neutral to bearish view, meaning they hope the price stays the same or goes down. The seller's payoff mechanic is the opposite of the buyer. The seller keeps the full premium as a profit if the index stays below the strike price. For example, if you sell the 17,300 call, your max gain is a profit of 327, but you start losing money if the index rises above 17,627. If you sell the 17,600 call, your max gain is a profit of 130, and your loss zone starts above 17,730. Next, we will analyze put options from a buyer's perspective. Here, the buyer is bearish and expects the market to fall. With the index still at 17,562, we look at strikes ranging from 17,300 to 17,600. In this case, the 17,600 strike is in the money and has a high premium of 167, while the 17,300 strike is out of the money with a low premium of 65. If you look at the value breakdown for these puts, the 17,600 strike has an intrinsic value that equals to 17,600 minus 17,562, which equals to 38. The time value is 129. For the 17,300 strike, there is zero intrinsic value, so the entire premium of 65 is time value. This is why sellers charge a higher premium for in-the-money contracts. Looking at the profit matrix, we can see how these options perform if the index falls drastically to 17,000. As the price falls, the profitability increases for all put options. For the 17,300 strike, the profit is 235, and for the 17,600 strike, the profit is 433. Each strike has its own break-even point, such as 17,433 for the higher strike and 17,235 for the lower one. When we compare the return on investment for this market crash scenario, we find a very interesting insight. The buyer of a deep out of the money put option gets a much higher percentage return. The 17,300 strike gives a return of 362%, while the 17,600 strike gives a return of 259%. Even though the in the money option made more total profit, the out of the money option was more efficient relative to its cost. However, the perspective of a seller of a put option is very different, as they are usually neutral to bullish. If the market crashes to 17,000, the put seller faces a reality check with heavy losses. Selling the 17,300 put results in a loss of 235, while selling the 17,600 put leads to a loss of 433. The seller only keeps the premium if the index stays above the strike price. In summary, a put seller has to balance premium income against risk exposure. Selling deep in the money puts offers a higher premium income but comes with much higher risk. On the other hand, selling deep out of the money puts is less risky but provides a lower premium income. It is always a trade-off between how much you want to earn and how much risk you are willing to take. From a trader's perspective, success in the market depends on 3 steps. First, you must analyze the current market conditions and understand your own risk appetite. Second, you choose the right instrument, whether that is futures or options with specific expiries and strikes. Finally, you devise a strategy that aligns with your analysis. Ultimately, your success relies on picking the tools that best fit your view of the market and your tolerance for risk.